We are in for a treat today as I welcome in our speaker, Justin Rice, who's going to be speaking on Social Security Decoded, Essential Insights for Optimizing Retirement Benefits. And it is my pleasure to introduce Justin. He's an accomplished professional with a multifaceted background in finance and education. With a degree in biomedical engineering from the Catholic University of America, Justin continued his studies, earning a master's degree from Rutgers University while venturing into the world of finance. He is a certified financial planner since 2018, and he also holds the Certified Student Loan Professional designation, helping clients tackle student loan challenges. As a sought-after industry speaker, Justin has shared his expertise with various groups, including the Financial Planning Association of New Jersey chapter. In 2021, he earned the certificate in blockchain and digital assets, making him a go-to resource for the ever-evolving world of digital finance. Join us as Justin unveils the intricacies of Social Security and empowers us to make informed decisions about our financial future. Let's embark on this enlightening journey together. Justin?
Thanks so much, David, for that wonderful introduction. I will look to share my screen, so hopefully that's popping up well for everyone.
Justin, hold on. You got me.
I'm back. All right. Yeah, you muted yourself too. So that's all good. Social Security Decoded. And yes, it does need some decoding because it is quite a complex system. And it's funny, I have my certificate in student loan planning as well. And looking at that was also a program created by the federal government, quite as complicated too. So Social Security is no different. And so looking at that and looking at the benefits of student loans, although completely different groups, are a little bit similar as well, just complicated systems. So let's ask the question, because that's probably why you went on the webinar today, is when is the best time that you should start to receive your Social Security retirement benefits? And let's go to the source. Let's go to Social Security Administration and see what their website has to say about when's the best time. So at Social Security, we're often asked, what is the best age to start receiving retirement benefits? And the answer is that there is no one best age for everyone, and ultimately it is your choice. Well, thanks a lot, Social Security Administration, for providing us with that great advice. But it is actually a complex decision because of the complexity of the system that has been built. In fact, if you're a couple, you can choose from as many as 9,000 possible different claiming combinations between when you start your benefits. And SSA is really prohibited from giving advice to consumers or professionals. They just can give information about the program. They can't really give claiming advice. They can also not coordinate with outside assets. So if you've got another pension coming in, if you've got other retirement benefits, IRAs, 401ks, they're not going to be able to look at those benefits to see when it's going to be optimal to claim your Social Security benefit. And also on top of that, the rules and laws continue to change. So the biggest overhaul was back in 1983, and then more recently in 2016, when they removed some of the advanced planning strategies and some of the loopholes that they would have called that allowed people to get even more benefits from the program. But let's start with the very, very basics of Social Security. You have to have 10 working years to be eligible for your own benefit, and they actually break those up into 4 credits per year. So once you earn the 4 credits, you can earn up to 4 in 1 year. You could do that for 10 years, and you have the 40 credits to be eligible for your own benefit. Now, the calculation to your Social Security benefit, they use your 35 highest years. And so if you haven't worked for 35 years, they will fill in those other years with 0 and include that into the average. And so if you don't have the 35 years, that will reduce your benefit because you're going to be including zeros within there. Now, FRA is an acronym that you may hear of. That stands for full retirement age. This is a little bit funny, and where the complexities already start to begin, because clearly they don't have a great grasp of the English language. Because when I think of full, and if I think of a cup as being full, that means no more can fit in. So that's like the maximum that you can have, right? And your full retirement age is anywhere between 66 and phasing up to 67 right now as we speak. But that's just because it's a full retirement age doesn't mean that's the most that you can get. And in fact, if you don't claim at full retirement age, you can continue to delay your benefits as late as age 70 and continue to earn those delayed credits to get your maximum or real full benefit. So they're actually talking about changing that language, but that's the language that it is currently. Then you have PIA that you may have heard of as well, which is the primary insurance amount. This is the benefit that if you file at your full retirement age, that's the benefit you would receive. And so if you've maxed out your 35 years, the most that you can get as a PIA is $3,627 per month. That's in this year, 2023. Now, taxation of benefits is an interesting topic as well, and that phases in. So Social Security, if that's the only thing coming in, it's basically going to not be taxable to you at all. But as you start to add more income from different sources, from pensions, from IRA distributions, from 401k distributions, you will start to phase in that taxation. But the most that Social Security will ever get taxed at the federal level is up to 85% of your Social Security will be taxable as ordinary income. They're not just going to take the 85%. That flows into your taxable income and then is taxed at your normal brackets. So it is from a distribution phase quite favorable compared to an IRA, which is going to be fully taxable from dollar one. Social Security, as at most, is going to be only 85% taxable. State taxation will vary. So we're in New Jersey. There's no state taxes on Social Security here in New Jersey, but I think there's about 7 states that do tax Social Security benefits. So let's take a look quickly at the 3 important ages. You've got 62, which is the earliest that you can claim retirement benefits. I say retirement there because there is actually earlier ages where you can still have Social Security benefits, but we won't go into that. Your full retirement age, which again is phased in from 66 to 67, and then age 70, which is going to be the latest you can get those delayed credits. And you can see the various percentages of the primary insurance amount. So at full retirement age, it's equal to the PIA. If you claim early, you're going to get about 75%, 70 to 75% of the PIA, losing out on some of those benefits. And then at 70, you're going to get anywhere from 124 to 132%. Again, that depends on when your full retirement age actually is, depending on your year of birth. So looking at your year of birth, if you're 1954 or earlier, 66 months. And then 1955 through 1960, it goes up by two months until you reach 67 as the new full retirement age. So if you're young like myself, you can also probably not pay attention to this at all, because I do imagine that they will shift this further. But if you're closing in on these dates, this is most likely what it's going to be, because any changes that they may make probably won't affect those that are currently claiming or close to claiming. At least that's precedent. Now let's take a look. We already saw the 62 was the earliest that you can start claiming those retirement benefits, but what's the true impact of that? Not just looking at the percentage of PIA. And we'll use some hypothetical numbers here. So let's assume your full retirement age is 66, your PIA is $2,000. And so claiming at 66, you get $2,000. But what if you claimed at age 62? Well, it would get a 75% reduction. And so you'd actually be only getting $1,500 per month. But how about if you claimed at age 70? You'd actually get a much higher amount at $2,640 per month. Now, comparing it to the base PIA, it doesn't seem that big, either going down or going up. But if you look at the difference between 62, the earliest you can claim it, and age 70, the latest you would claim it, that's actually a difference of $1,140 per month, which is a 76% increase from age 62 to 70. So yes, it's a big deal to delay those benefits. Now, there are some possible reasons why you may consider claiming early. The first one is you just flat out need the money. If you're retired, you don't have other sources of income, and you just need the money to live on, definitely there's no reason to delay, because you really can't. If you're in relatively poor health, and your life expectancy is much shorter than average, then you may consider claiming early, but maybe not. And we'll talk about that a little bit later. The spouse with the lower earnings history. Now, this is an interesting one when we start to talk about survivor benefits, because the spouse with the lower earnings history, that benefit is going to go away when the first spouse dies. So when the first spouse dies, that lower benefit is going to go away, and you're just going to be left with that higher earning benefit. So claiming that early doesn't necessarily hurt the long-term projections from claiming. You also, if you claim early before full retirement age, you want to be careful of the earnings limit. If you're still working, you can earn up in 2023 up to $21,240 in a year and still be able to claim the amount of Social Security benefits. Once you start earning more than that, they're going to have clawbacks of your benefits, and if you earn high enough, the benefits won't even kick in at all. So you definitely, there's no reason to claim early if you're not going to receive the benefits anyway, because your earnings are too high. Spousal benefits are something that you definitely want to pay attention to. So in order to be eligible for spousal benefits, you have to be married over 1 year. And your benefits are going to be based on the spouse's earnings record. So you can actually claim Social Security benefits and not have any work history, because you can solely base that benefit on your spouse's earning record. Now, in order to claim those spousal benefits, the spouse must file first. And so you can't start claiming spousal benefits when the primary earning spouse is still delaying their benefits. So it has to happen either at the same time or after. It's gender neutral, so it doesn't matter male or female. It just matters work history. And these spousal benefits don't earn delayed credits. And so for retirement age, you get 50% of the benefit. And if you claim past that, it's still 50%. If you claim before that, there is that reduction, but it doesn't earn those delayed credits. Now, here's a tip if you want to maximize Social Security, because in most cases, assuming you can afford it, you don't need the money, it makes sense for the higher earning spouse to delay benefits up to age 70 to lock in the maximum benefit. Now, that comes because of the survivor benefit, because even if, and I said earlier, a possible reason to claim early would be in poor health, even if the higher earner is in relatively poor health, it still may make sense for them to continue to delay benefits, because that benefit will continue to the lower earnings spouse for their lifetime as well. And so claiming it early as the higher earning spouse doesn't just affect your benefit, it actually affects your spouse's survivor benefit as they continue. So typically, in most cases, if you're the higher earner, it makes sense to delay your benefits as long as possible. Now let's talk a little bit more about survivor benefits and how those work. It's available after that the first spouse passes, you've been married longer than 9 months, and you are not remarried before the age of 60. You get the larger of the benefits, so you can't claim both. You'll just get whoever's is larger. So if the lower earning spouse passes away, you just stay with your benefit and don't get anything additional from them. So that's why one of those possible claiming strategies, or that split strategy, is when you have that lower earning spouse claim their benefit first, because that benefit will be the first one to go away when either of the spouses die. Because if the high earning spouse dies, their benefit moves over, and the lower earning spouse doesn't earn their benefit anymore. They just earn the higher earning spouse's benefit. Now, the survivor benefit does have some flexible filing options. So, for example, you can actually still claim a survivor benefit and let your own benefit delay. And so, for example, let's say you can start claiming survivor benefits as early as age 60 if it was a young death. And so, at age 60, you can claim the survivor benefits. It's going to be reduced at that time, but your benefit, assuming that you have a work history, still continues to earn all of the delayed credits. And then you can eventually, once it's higher or at age 70, flip over to your benefit to then capitalize on that for the rest of time. So there are some things you want to pay attention to in a survivor situation. Divorce, there's also some filing strategies around that as well. Now, this is actually filing based on an ex-spouse's record. Now, in order to do this, you have to follow some rules as well. You both must be at least age 62. You have to be married for at least 10 years. And by the way, this can happen twice. If you have two ex-spouses, both married for over 10 years, you actually get a choice of which one you want to use. And obviously, you would use the higher one. You have to be divorced over 2 years, or you can be divorced more recently, as long as the ex-spouse is claiming their benefits. If they're not claiming, you have to be over 2 years before you can actually claim, and you haven't remarried. You do not need to contact your ex in order to file for divorced filing, and it's not going to affect their benefit at all. So it doesn't affect them. It's solely for your benefit based on their record. It doesn't reduce their benefits at all. You don't need to contact them at all. So you can still claim that. Now, an interesting strategy that is phasing out is a restricted application for divorced benefits. And so we had one client that we were able to claim a divorce benefit, filing a restricted application so that it allowed their benefit to continue to earn the delayed credits. So eventually they would be able to flip over to their own benefit at age 70. Now you can't do that anymore if you were born after January 1st, 1954. So that strategy has gone away. That's one of the things that they removed back in 2016 when they made some of those changes. So a couple people will still be able to take advantage of this, but most likely you'd been phased out of this. Let's talk about the cost of living adjustment, because Social Security does increase with inflation, and it's designed to do so. It's tied to the CPIW, which is based on workers and wage earners. And for 2023, we got the largest cost of living increase in a long, long time, 8.7%. So many in 2023 are, I'll say, enjoying that, even though inflation is also very, very high. So it really just kept up with what they were spending anyway. Going into 2024, the official is not released yet, but they're expecting another 3% increase in Social Security benefits going into 2024. But is this cost of living in all these increases actually enough to keep up with the pace of inflation? And this is actually what the Senior Citizens League took a look at. They created a report where they looked all the way back to 2000 and did the calculation of Social Security. We've had an average cost of living adjustment of 3.4% per year since then. But if you look at the cost of goods and services for a typical retiree over that same period of time, it's actually increased by 6.2% annually. And so the result is that if you were a retiree in 2000 or before, you've lost more than 1/3 of your purchasing power from the original Social Security benefits. And so although, yes, it is tied to inflation, yes, it will increase, you definitely don't want to rely on that as your sole increasing for future income to fully cover inflation, because it may not for you. Now, there will be more changes potentially ahead. So the annual report from Social Security, the board of trustees, they released it this year in March, and they released it every year to look at the health of the trust funds. And here's a quote from this year: the projected reserve depletion date for the combined OASDI, that's the Old Age Survivor Disability Insurance Trust Funds, is 2034, a year earlier than in last year's report. So it's not getting any better, it's getting worse, the timeline. So what happens in 2034? Those trust funds deplete. Well, after the projected trust fund reserve depletion in 2034, continuing income would be sufficient to pay 80% of program cost. What does that mean in English? That means the benefit that you're receiving from Social Security will reduce by about 20% if Congress doesn't do anything to fix the Social Security program, because they can only pay out, it's supposed to be a self-sustaining program, they can only pay out of what the program takes in. And once the trust fund is gone, they can't pay out more than that. And so they wouldn't be forced to reduce benefits for everybody when the trust fund depletes. And so clearly they're going to look to address this, and the sooner that they do, the better. But there's really only one of two answers. You have to increase taxes or decrease benefits. It doesn't take rocket science to do this, but it is going to be painful. And actually, it's funny to point out here too, that because they're obviously looking at this to kind of see actuarially what changes will need to be made to make the program healthy again. One of the changes that they looked at was moving the earliest you can claim benefits from age 62 up to age 65. Now, besides pissing people off because they can't claim their benefits at 62, it's probably a bad strategy because that actually hurts the trust fund actuarially, meaning that it's better off to let people to claim early because they're getting that reduced benefit. So really, if you're claiming early, you're helping the Social Security system because you're less of an actuarial cost to the system. So thank you for those out there claiming early. You're actually helping to make Social Security continue to be healthy. But if you want to try to take the most of it, then it probably makes sense to delay your benefits. Now let's take a look at taxation of benefits, because we said 0 to 85% is how Social Security is taxed. And we said that Social Security Administration can't coordinate with other assets. So if you got pensions coming in, you've got IRAs, income coming in, that's all needs to be taken into account to look at your total situation. And what's interesting is if you just have Social Security, you're not going to be paying taxes on it. Basically, after Social Security, they're only taking half of that as provisional income, plus you've got your standard deductions. So it's going to be really hard to have any real taxes paid if you just have Social Security. But what if you start adding in other pieces of income? Something interesting, very interesting happens. So let's talk about how they make these calculations. You have the provisional income that's used. And so what's provisional income? It's going to be your adjusted gross income, excluding the Social Security, plus they add in tax-free interest. And so that tax-free interest, although it's not taxable to you, it may actually push some of your Social Security to be taxable, and half of your Social Security income. And after all of that's calculated, if you're a single filer, and for married filers, it's a little bit higher, not double, but a little bit higher than this. You can go from 0 to up to 50 to up to 85%. So over 34,000, you start to phase into that up to 85% taxed. Now, that creates an interesting scenario where you have the Social Security that can actually be phased in to its taxation as you continue to get more income. And that's what I did not create this name. It's out there called the tax torpedo. It's got some nice alliteration. Otherwise, I don't know why it's named the tax torpedo. You can see it's going to blow up your retirement or something. But if you look at it, what you can see, if you only claim Social Security, and that's here in this scenario, I've only claimed Social Security, no other income coming from elsewhere. But something very, very interesting happens as you start to get more and more income. You're getting phased out by the standard deduction, and then you enter into the 10% bracket, or so you would think, and that's this blue portion here. But what happens is that as you add the taxation from the ordinary income from the IRA, you're also pushing a new dollar of Social Security to be 85% taxable as well in that bracket. And so really every new dollar that you take out, your tax rate isn't 10%, it's actually 18.5% net effective tax. And then as you increase in the brackets, you go from the 10 to the 12, but it's actually really feels more like 22%. And then you go into the 22% bracket, and your net effective rate is actually over 40%. And now we're just talking about federal. This is not even looking at potential state taxation too. And what if you add in one other wrinkle? What if you have a taxable account that's throwing off some capital gains every year? So what if you add some capital gains into this equation? Well, that makes it even more fun because capital gains also has a 0% tax bracket that can be phased out. And so once you add in some capital gains, so all I did from the scenario 1 to scenario 2, added in some capital gains, and you can see once those capital gains start to get phased in at 15% taxes, federally speaking, you can get into an almost 50% effective tax bracket just between the additional taxations of Social Security, capital gains, and the 12% normal bracket. So very, very interesting, and you have to watch out for these different types of taxation when you're looking at taking withdrawals and claiming Social Security at the same time, which points to another reason to delay Social Security is you can use different strategies like Roth conversions while your income is still low before you start turning on Social Security and avoiding this tax torpedo. So what if you attend this webinar and you just filed your Social Security benefits a couple months ago, you're receiving benefits now, and you said, maybe that was a mistake because I want to continue to delay. Well, you can actually withdraw your application. It can only be done once in your lifetime, and it has to be completed within the first 12 months that you claim benefits. You do have to pay back any of those benefits that you've claimed, but then you can just reset and say, it's like I never claimed it, and we'll continue to delay the benefits. Another potential option, if you've been claiming for longer, is after you reach full retirement age, you can suspend your benefits at that point in time and then continue to earn delayed credits until you reach the age of 70. That method is not, you're not going to get the full amount of benefits as if you had delayed the entire time, but it will give you some delayed credits, and it does not require that you pay back any of those past benefits that you receive. So that's another potential option that you can look at if you are currently claiming benefits. What are the key takeaways from you? So the key takeaways here from this is that Social Security is an important part of retirement income. It's definitely not meant to be the entirety of income, but it is a guaranteed stream that's inflation adjusted, and it is a key portion in a lot of our clients' plans. there are several risks that you need to look for to make sure to optimize your claiming strategy. If you don't care and you just want to say, hey, I just want to take my money as early as possible because I don't trust the government, do that. That's fine. But if you're really looking to optimize your benefits and trying to get the most out of the system that you can because you put the money in, definitely you want to look at and trying to optimize those strategies. And just due to the complexity of the system and the shifting of the rules and the regulations, there are planning challenges due to that. So you want to be able to stay on top of that and maintain and look to make sure that the strategy that you're using is the best one for you. So here are some action steps that you can immediately take following this webinar. And the first one is, if you haven't already, to go create your account at ssa.gov. So that is the portal. They actually just updated it not too long ago to bring it up to more modern times. And they've got some different cool calculators that you can use. You can find your estimated benefits there to see what is estimated, and then you can do some projections right there in the ssa.gov website. You can analyze those different scenarios by yourself, just of seeing the different strategies of when to claim your own benefit. You also want to consider, if you are married, any of the spousal implications that we talked about before, and you also want to consider any beneficiary implications as well. And finally, you want to make sure to take into account the taxation of those benefits. How will Social Security be taxed? And can you, before you claim Social Security, take advantage of any income shifting, Roth conversions, so that you can set yourself up for a better tax scenario long term once you do start claiming those benefits? I can now take some questions if there are any. We can throw them in the chat, but otherwise, this is my contact information if you want to follow up for any personalized advice.
Thank you so much, Justin. That was really, really good. Can you slide back to the last slide, the action steps?
Yeah.
So on action step, when we get to action step number 3, to analyze the different scenarios, are you able to help people to analyze their options? Are you available for consultation to help decide when's the right time to take Social Security?
No, don't contact me. Yes. So yes, we can definitely work. And as part of our comprehensive financial plan, there's a section on Social Security that we discuss to make sure that we're doing everything that we can to look at those different scenarios and find out when it is most optimal to take that benefit. So yes, that's something that we can help out with.
Very good. Thank you. Thank you. It's funny, and listening to your presentation, which was really thorough, and I really appreciate that information. It makes me think a lot when we're doing income tax planning, where there's a thought in income tax that the taxpayer is under no obligation to pay more than they have to, but it means you have to know enough to minimize what you do pay. So the government says, if we have these deductions and you want to take them, go ahead and take them, but we're not going to call you up and say you missed one. So the same holds true here with Social Security. If you don't maximize your benefits, Social Security Administration is not going to say, hey, have you thought about this, or did you think about that? They're going to say, sure, we'll process it and we'll have you get your Social Security benefits just as you filed. But to work with somebody to help walk you through this can be really good. All right, so we have our first question coming in. Lorraine wants to know, does the spouse receiving Social Security benefits have to call to determine if there are survivor benefits? Can the spouse call Social Security Administration and get that information?
All right. Does the spouse receiving have to call? So, yes. You'll have to call and look up. Can the spouse call? Yes. So the spouse will be able to call and get all of that information. So from either survivor or or in the case of divorce benefits as well, when you don't have to contact the ex, you don't have to contact the deceased spouse, the Social Security Administration will be able to tell you your benefits based on spousal records. And you have to just prove that you were married for the required 10 years, and they'll have you connected, and then they'll be able to calculate that for you. Then you'll be able to look at those spousal benefits. You'll be able to look at your own benefit to see which one you would want to claim.
And while we're thinking about survivor benefits, one of the things that comes up also is survivor benefits are also subject to the income testing when you're below the full retirement age. So at age 60, if you're still working, you may not get a survivor benefit because you have the income to offset it. All right, we have another question here from David. Doesn't the increased benefit from a delayed claim have to be balanced against the benefits received early? My delayed benefit increases by $500. If I took benefits early, my benefit is $50,000 a year. Wouldn't it take 100 years for me to make a benefit?
From later benefits.
Running off the wrong page. From my later benefits. Yes, thank you.
Yeah. So that's something that we factor into the break even analysis. And so if you live to a certain age, it's going to make sense to delay benefits. So you can even factor in that, hey, what if I claim benefits now and save that, save it to invest it so that later on I'll be able to take even more out because I'm really good at investing. But when we look at the delayed credits that you do receive, it's an 8% increase per year. And so that's a very, very good increase. And by the way, that increase, once you start claiming, is also inflation adjusted as well. So you can't just factor in the straight math of it. You also have to factor in all future inflation as well, because inflation on a bigger benefit is going to lead to even bigger benefits. And so you have to factor that in, and we calculate that break-even age, and we can say if it's age 82, then if you die before 82, then you would have been better off claiming benefits earlier, or if you die after that, then it's better off to delay. And if you have spouses, you can actually look to see because that when the higher earning spouse passes away, they still get that higher benefit, and so you have to look at that as well. To see the different, when spouses are going to live, to see when that break-even point is.
Yeah, I can tell from experience, the number one question we get as people approach retirement is, will my money last as long as I last, or am I going to run out of money? So for most people, the longevity risk, the risk of living too long, is much greater than the risk of starting early and getting a bit earlier payments. All right, we have another question for you. What is the role of your tax accountant in planning for retirement and Social Security benefits?
Yeah, so I mean, your tax accountant should work closely with your financial planner to be able to coordinate those benefits. So the financial planner can do different, various tax projections, but obviously there may be things that the planner missed that the tax accountant will be seeing on the return. And any moves that the planner makes, they have to be in contact with the accountant to let them know that they did it. So for example, if you are unrelated to Social Security benefits in particular, but let's say you're over the age of 70 and a half and doing qualified charitable distributions, and where you take money directly from your IRA and gift it to charity. That will still generate a 1099, but you have to have the communication between the planner, the client, and the tax accountant to know that portion that was gifted directly to charity has to be reported as non-taxable on the tax return, or else you did that cool move for no benefit because the accountant didn't file it correctly because they didn't know. And rating it back to Social Security, if you have to do that, and let's say your RMD now is coming out, and you want to do that, and you're in that phase-in portion where that RMD is going to take you into that potentially 50% tax bracket, doing a qualified charitable distribution might save you that much. And so that could be the difference between a $5,000 qualified charitable distribution. If you're in that scenario where capital gains was phasing in and Social Security taxation was phasing in, a $5,000 qualified charitable distribution could save you $2,500 in taxes under that specific scenario if you're in that range. So it could be a big impact, and you want to make sure all of these things are coordinated.
Good. Yeah. I always say that financial planning is a team sport. It involves the disciplines of law, disciplines of tax, discipline of investment, several other disciplines that come into play. But what we've found now in today's society is so many people have gone to a lower cost option. So their tax accountant might be a software package now. Their legal advisor might be LegalZoom. And an accountant could serve many roles. But the primary one for most people is tax preparation. And if your accountant is doing tax preparation, but not much more, somebody has to pick up that ball. Either you need to find a new accountant or you need to have somebody else do that tax planning. But certainly somebody has to play the role of evaluating the tax impact of whatever you do. So along those lines, Justin, we have a question from David. Do you provide tax planning also?
Yes, that's another section in our full comprehensive financial plans that we do for clients. We definitely look at the tax implications of anything that we're going to do, and trying to optimize that as well alongside Social Security, alongside the other components of the plan. Because if you ignore taxes, you're going to have a suboptimal outcome, because not everything is going to be looked at the same. Obviously, Social Security is taxed differently than IRA distributions, is taxed differently than Roth distributions, is taxed differently than distributions from your other investments that pay off capital gains or dividends. And so it's all different. And so looking at the optimal combination of, if you need more income, where to take it from, that's all incorporated into tax planning. And so yes, it's a very important piece, and we do that.
Very good. Thank you very much. I've got one more question. Do you have a suggestion? Oh, here we have a suggestion for future sessions, explaining various retirement plans, SEPs, Roth and IRAs, and I think that's a good idea. So thank you, Lorraine. We'll put that one on. We were just talking about some future programming. So if anybody has other suggestions, please feel free to send them in as well, because we're looking for ideas that will be of interest to our listeners. So Justin, I want to thank you for your presentation today. You started off by talking about government programs, much like student loans, much like the tax code, much like Social Security, much like the legal laws and regulations by the government. This was as clear as day, and there should be no questions ever again. Now, in all seriousness, what it points out is that you need to work with people who know what they're talking about. You need to work with people who can help answer these questions, because they're all valid questions. And there's a statistic out there that shows that the largest financial mistake that most people make involves Social Security and not knowing what their claiming strategy should be. So we don't want you to make any mistakes. We want to help you. And if we can be of help, please reach out to our office, and we'd be happy to provide any assistance that we can. Now, along those lines, we will be doing this again next month. So please register if you haven't done so already, because we're going to hit on the other big item that people hit as they retire, and that is Medicare. And we're going to have a program on navigating Medicare, essential insights for approaching age 65. And we're going to bring in a Medicare expert, Mark Brownstein, to present on that. So I don't know anybody who approaches 65 who doesn't have any questions about Medicare. So, and for that matter, if you're already past age 65, there's probably still questions that you have. So please join us next month and every month. And if you haven't done so already, you can go to our YouTube channel and search on Personal Wealth Strategies and subscribe to that so that you'll be getting notices when we post our recordings. But if you give us a week, you'll be able to watch a replay of this on our YouTube channel. So once again, on behalf of Justin and myself and everyone here at Personal Wealth Strategies, thank you for joining us today, and we look forward to seeing you soon.